So my name is David Fauché. I run an investment firm called Cambriel. And what we do is we run a fund of funds strategy for the digital asset space. And so our job essentially is to find, to speak with, to analyze, and to invest in other crypto funds. And as part of that, we get to basically spend a lot of time thinking about the entire sort of universe of crypto kind of related investment activities and what would make sense for a fund versus different other players. And so this is what I want to talk to you about today, which is what are the kind of universal investment strategies and things that we can apply in crypto networks, and in which of those does it make sense for a fund to participate. And that's where the generalized mining piece really comes in. And so what I want to start by doing is suggesting to you that we can think of crypto networks as n-sided marketplaces. At an abstract level, if you think about Bitcoin, what you really have is users on one side that would like certain things. They would like a ledger on which they can store a balance. They want to be able to update that balance to make transactions, so to update the ledger, and they would like the ledger to be secure. And users basically pay transaction fees through the Bitcoin protocol to the service providers of that service, the miners. And the miners do the work of securing the ledger, of updating the ledger. And so you have this sort of marketplace that's two-sided, that's mediated by Bitcoin kind of as a protocol in the middle. If we move on to Ethereum, again, we see a similar sort of structure at a conceptual level. You have users that would like to run computation. And on the other side, you have kind of Ethereum miners who are running those computations in exchange for fees. And again, the protocol sits in the middle, mediates the relationship. It's a set of rules, and it basically enforces those using cryptography. If we think of Filecoin, Filecoin is sort of a yet-to-be-launched but pretty mature protocol for file storage. It's sort of like a Dropbox, but decentralized. And what you have here, again, is users on one side who would like to store files as they would on Dropbox, and they are paying fees to storage miners who do the work of actually storing the file, and retrieval miners who do the work of sort of retrieving the file and serving it back to the user whenever they want. And so here we have kind of a three-sided marketplace, again mediated in the middle by the protocol. This is Orchid. Orchid is basically a decentralized Tor network, similar to a VPN. What the users want in this case is they would like a kind of anonymous web browsing, anonymizing their internet traffic, and they're paying proxies and relayers transaction fees in order to provide that service. And the relayers and proxies are basically proxying, relaying, providing the bandwidth of moving these kind of internet requests from one side of the world to the other, and they get paid fees. And so then we can sort of move on to a little bit more sophisticated crypto networks, like Maker. Maker is a stablecoin. Stablecoin is basically this idea that you can issue a unit of value as a coin and have that be, for example, pegged one coin to $1 US, and have that kind of unit have stable value over time. And what happens here is that users will post collateral to a Maker smart contract. In exchange of that, they get a stablecoin called a DAI. And so you have kind of on the one side this loop happening, and then on the other, you have the sort of service providers in this case, which is a set of what Maker calls keepers. And the keepers are the people that basically, in exchange for kind of profit opportunities in terms of arbitrage and market making, are doing the work of providing the stability and maintaining the peg of DAI. And what they're doing is, you know, whenever they see the collateral dropping below a certain level, they're liquidating the contract, selling off the ether, and reestablishing the peg. And so what you have here is just a multi-sided marketplace. But again, you have a protocol sitting in the middle and mediating the relationship. And so what I would suggest to you is that if we are going to get to this point of maturity in crypto, we're going to have a lot of different protocols out there that are basically performing these marketplace functions. And that's going to open up a multiplicity of opportunities for network participation and for sort of economic activity. And I would suggest that you can break this workout into three separate kind of distinct buckets. The first bucket is kind of what we call consensus work. This is stuff like, you know, traditional proof of work, Bitcoin mining, but also some of the newer sort of proof of stake validation. The idea there is there's some sort of a leadership election in order to sort of achieve consensus around the state of the blockchain. And what people are doing here is really, you can think of consensus work as the cost of trust, the cost of achieving consensus and maintaining a state that everybody can agree on so that the protocol can move forward and transactions can be affected. You have a second type of work that we call provisioning. And this is the actual provision of the end service that people want. And so the good example here would be in Filecoin, as an end user, I would like storage space, and I will pay a person, a service provider, to provision the service of storage space for me so that I can store the files. And provisioning is really an economic activity rather than an investment strategy. And then finally, you have, around healthy crypto networks, you have this sort of these third-party kind of services, this third-party economy, as our friends at CoinFund put it, of different kind of actors that are able to emerge in the space around the network and provide services. And so this, going back to the example in Maker, is the keepers that are arbitraging DAI and maintaining that peg. It's things like, if you're familiar with the Lightning Network, providing a payment channel, providing liquidity to the network. So it's tangential to the network, but it's still important for the proper functioning of it. And so the question really here is, there's a ton of opportunities for participation in networks, but what actually makes sense for a fund to do versus an infrastructure provider or anyone else? And at the moment, we don't think that people have been doing the kind of thinking around this that they should be, because we see all sorts of people from all sorts of walks of life with all sorts of structures, companies, funds, etc., all kind of testing the waters and doing the same stuff. And so we've been doing some thinking about what a fund should do versus an infrastructure company, for example. And the conclusions that we've come to are these, that for consensus work, the winners in this space are going to be infrastructure companies and kind of large fiduciaries. And so the reasoning for that is, if we think of kind of proof of work mining, and what we have here is basically a bunch of people that are all buying the same chips from the same 1 to 3 suppliers, and then they're applying electricity to them, and they're competing firstly on the basis of access to the chips, and secondly on basically the cost of kilowatt hour. And the kinds of people that are good at making chips are large chip companies. The kinds of people that are good at cutting deals with governments, with cities, with regional kind of players, getting tax breaks, achieving sort of a contractual 10-year cost of electricity below market rates, are not software engineers. They're not fund managers. This is an infrastructure game that's best left to people like Veolia and GE, large private equity firms, and these kinds of guys. So we think that on the proof of work side, what really makes sense is kind of infrastructure players doing that. And I do realize that this is really far removed from the kind of narrative and the hopes of a lot of people in this space around how mining will be distributed around the world. On the validation side, if you think of proof of stake validation, what's happening is that you own a stake of a particular token. And then, either because of network inflation or because you can earn fees, you participate in these leadership elections and validate or stake behind the validation of the next set of transactions, and you earn fees for that. And so there's either an economic loss through inflation, or sort of you're not taking advantage of an economic upside by not participating in the network. And so there's an economic incentive to participate. The issue is that most people have kind of bandwidth in terms of being able to validate, which is a technical activity, and even just caring about what the next block that gets validated is. And so what we see is people will delegate their stakes to professionals, and those professionals will do the validation on their behalf, earn fees, and then spread the fees back out to the original delegators. And what this starts to look like financially is basically a savings account, because you're taking your stake, you're delegating it to someone else, and you're earning an interest on it. And there is also the sort of opportunity or possibility of having a catastrophic loss event. So, the person that you delegated your stake to makes a mistake, and their stake gets slashed or confiscated or penalized in some way, and so you kind of share in that loss. So what this looks like is a savings account, And if you have a savings account and you have savings, you don't go and kind of deposit your savings with the dodgy guy around the corner. You go and you give your savings to Wells Fargo, to JP Morgan, to Fidelity, to someone that's sort of like deep in the ground, institutional, fiduciary, government-backed type players. So we think for proof of stake, this is a sort of low interest bearing type product, and the real operational leverage that somebody can have on this is that they can get other people to delegate stakes to them, and because there is kind of no marginal cost to staking other people's delegations, you can earn outsized returns. And basically, it's going to be brand and whoever can achieve a Schelling point around being this sort of trusted fiduciary for stakes. I don't know if that will be Fidelity or Coinbase or somebody else, but we think it's going to be one of these large institutional players that win in that space. And then we can sort of move on to provisioning work. And provisioning work is kind of interesting. You have, again, these people that are providing services through the network to the end users. And this looks like providing storage on Filecoin, providing bandwidth on Orchid, but also one of the interesting examples is this protocol called Kleros. Kleros is a decentralized arbitration platform. So the idea is that sort of Alice and Bob have a dispute over a contract. That contract is posted somewhere, and you can sort of post this dispute to a randomly selected group of arbitrators who will review the sort of documentation and arbitrate in your favor or against it. And the idea there is that you could have people participating, actually probably humans and lawyers, participating through a protocol as an arbitrator in exchange for fees. This is not an economic activity. It's not a kind of investment activity. It's an economic activity. And the people here that are best suited to play are the existing service providers. And you can sort of imagine over time a sort of crypto equivalent of the gig economy growing out of this. The only major sort of caveat that we have to this is that there is a space here for value-add early-stage investors, like proper venture capitalists, to step in to the networks and help bootstrap them. And in that scenario, provisioning actually makes sense for a fund. And this is the first time that we have actually heard a real kind of concrete, believable answer to what it means to be a value-add early-stage investor in this space. And so this is what we think the future of VC in crypto will look like. It's going to be VC funds that invest at the seed stage of a protocol before it's ever launched, that work closely with the team, and that on day one are there provisioning the network, mining on the network, which gives it sort of a minimum threshold at which it's actually functional. And by doing so, they are bootstrapping the supply side of the network, which allows the demand side to come in and try out the network, for consumers to try it, to like it, to use it, to adopt it, for the network to grow. And so you can imagine VCs stepping in from day one and participating in networks, earning fees for the first 3 months while other miners kind of come into the space and spin up nodes and validators and all sorts of kind of like provisioning compute on these networks. And then the returns coming down. And so from the VC's perspective, the first thing that you've done is that you've helped to bootstrap the network, helped it grow. The second thing that you've done is you've actually earned tokens for doing so. And so you can imagine participating, and this has happened a number of times, and it's been publicly documented as well, people participating in the seed stage of a network where effectively you are buying a token for $2. And then you work with the team, you launch on day one, you participate in the network, and you earn tokens rather than buying them. And you do that for 3 months. And what happens is that you're buying the tokens at $2, you're earning them at 50 cents, and your average cost of ownership has just been brought down while your stake size has doubled. And so this is an example of somewhere where you can actually only participate or gain some sort of economically rational position or holding in a network by actually actively participating. And this is something that just doesn't exist in the traditional world of VC. And so finally, we have these third-party services, all of these things that spring up around networks, things like acting as a keeper on Maker, running a payment channel on the Lightning Network, basically a bunch of activities around these networks that make them more efficient, where what you're really doing is interacting directly with a protocol, putting capital at risk, making some sort of a trade with an expectation of profit. And when you look at it from this perspective, what these funds are doing doesn't look that different from a traditional quant fund. It's basically market making and liquidity provision, arbitrage, things like this, but under a different name. And it looks a lot like what Renaissance and Two Sigma and these big quant funds have been doing for years. And what I would suggest to you is that the difference here is one of terrain, kind of blockchains, not the API of an exchange, versus the strategy. The strategies are very much the same. And I think that we're going to see some very interesting funds look very closely at this space and then start participating. And what we're going to see is basically that from the network's point of view, we need these kind of participants to come in and to do the work of consensus work in order to make the network secure, to provision the service, to make sure it's provisioned, and then to make these markets efficient. We actually need these sort of third-party services there in order for these markets to function. And so as we kind of step back, we think that there's a number of investment strategies that are sort of traditional strategies that are going to continue to port over into crypto. And people are going to continue doing, the things that they're doing. But there's a subset of managers that are going to spend the time and burn the neurons actually investigating, learning about, and understanding to a level of extraordinary depth and intimacy how these networks are functioning. And then they'll be able to find opportunities, and they'll take advantage of those opportunities. And by doing so, what they're going to do is to make these networks efficient, provisioned, secure. And what they'll end up doing is graduating where we are now, which is a bunch of really interesting experiments in cryptography and game theory and in public provision of services by a decentralized group of people, into public core infrastructures embedded into your life as the internet is today. And we're very excited to work with these managers, to find them, to exchange with them, and ultimately to invest in them. Thank you very much.